In this video, we're going to walk through basic journal entry transactions related to gains and losses on the disposals of fixed assets. We're given information regarding a piece of equipment we've bought. It cost $110,000, had an estimated salvage value of $10,000, and a 5-year useful life. And we're given the depreciation schedule for the equipment as well. And we're going to go through 3 different scenarios. We're told that at the end of the 4th year, the company sells the machine for $35,000. One of the first things we notice if we have a depreciation schedule built is that this equipment is on our books for $30,000. So if we sell it for $35,000, obviously we're going to have a gain. And we're going to see that as we start going through the journal entry and showing the impact on our accounting equation. First thing we know, if we sell the machine, we've got to take the machinery off our books. So we'll have a decrease in machinery for $110,000. If we take the machine off, we also need to take off the accumulated depreciation, which at this point in time we're told is $80,000. We're getting $35,000 in cash. So if we look at everything that's gone on with our assets, $80,000 and $35,000 is $115,000. We've got a $110,000 decrease. So we know our accounting equation doesn't quite balance. We need to have an increase in equity of $5,000, which is good because we record gains as credits and gains increase net income and will increase equity. I think it's easier to record journal entries or calculate gains and losses directly through our journal entry. So first thing we know, if we sell the equipment, we've got to take the equipment off our books. So we will credit machinery for $110,000. We take off the accumulated depreciation with a debit of $80,000. We got $80,000 in cash. We record increases in assets with debits. And again, notice we've got $115,000 in debits, $110,000 in credits. Debits don't equal credits. We need another $5,000 credit. And of course, we record gains with credits. So sometimes it's easier to go straight to the journal entry instead of dealing with the accounting equation impacts first. Let's take a look at another scenario. We've got the same machine. It's just now we're going to sell the machine at the end of the 4th year for $20,000. And I think even you and I can both look at this and say, oh, well, if it's on our books at $30,000 after 4 years and we sell it for $20,000, we're going to have a loss of $10,000. Now, if you don't have your depreciation schedule in front of you, it's really pretty simple to do. We would have known that we had $20,000 in depreciation expense every year for 4 years, so we have $80,000 in accumulated depreciation. We need to remove both it and the equipment from our books. So let's look at it from a journal entry perspective. First thing again, we could remove our accumulated depreciation of $80,000 because we just had 4 years. We have to remove the equipment at $110,000. We're getting $20,000 in cash. And again, if we add up debits, 80 and a 20 is 100, 110 on the credit side. Debits don't equal credits, so we know we need another debit for $10,000. In this case, we're going to record our loss. And again, I typically record the gain or loss part of the transaction last. We remove the machinery, we remove the accumulated depreciation, we record the cash, and then that gain or loss is our plug. And again, keeping in mind that losses will decrease net income and decrease equity and are recorded with debits, while gains will increase net income, which of course increases equity, and that's recorded with a credit. Let's show the impact on the accounting equation. Again, we had a decrease in assets, machine of 110. We have to remove the accumulated depreciation, which will increase our assets by 80. We're getting $20,000 in cash, and our total change to assets, 20 and 80 is 100, 110 for the decrease. We've got a $10,000 decrease in assets to keep our accounting equation in balance. We needed a decrease in stockholders' equity, which will be our loss. In our last scenario, rather than selling the equipment, after 5 years, our machine breaks down and we discard it. We throw it away because it no longer works. And if we're getting rid of the equipment, we want to take it off our books. So let's take a look at our journal entries. They're pretty straightforward. First thing, if we no longer have the equipment, again, we want to do what? Remove the equipment from our books. So we credit machinery for $110,000, the initial cost. After 5 years, we have $100,000 in accumulated depreciation. We, of course, need to remove that from our books as well. Debits don't equal credits. We need an additional $10,000 debit, and we're going to record a loss on the sale of $10,000. Again, we thought the equipment would have an estimated salvage or residual value of $10,000. It turned out to be worthless. So at the end of the equipment's life, we have a loss. One thing to keep in mind, if we had known originally, or at least thought originally, the estimated salvage value would be 0, we would have spread the $110,000 out over 5 years. And so instead of taking $20,000 in depreciation expense each year, we would have taken $22,000 in depreciation expense. Since we didn't take enough depreciation expense over the asset's life, at the end of the life, we have to record that additional $10,000 in cost. And we do that as a loss on sale.